Welcome to the July IASB podcast, where we bring you the latest insights from our board meeting. I am Nili Shah, Executive Technical Director of the IASB. And as many of our longtime listeners are familiar, we are joined today by Linda Mezon-Hutter, Vice Chair of the IASB, and Tadeu Cendon, one of our IASB members. So welcome to both of you.
Thank you, Nili.
Thank you for having me.
So in July, we finished discussing 5 projects. If you want the details of all 5 projects, please do refer to our website. But in this episode, we'll do a little bit of a deeper dive on 3 of those projects. The first is the post-implementation review of IFRS 15 on revenue from contracts with customers. The second is our project on rate-regulated activities. And the third is the second comprehensive review of the IFRS for SMEs standard. And the reason we decided to talk about these 3 projects is that they all have one thing in common, and that is that the IASB in July finished their technical deliberations, and they are now in the drafting and balloting process. So let's kick off with the post-implementation review of IFRS 15. Which, as many of you are aware, was developed as a converged standard with the FASB. And again, as many of you are aware, we normally conduct PIRs a few years after a new standard has been in effect to assess whether the standard is working as the board intended. A post-implementation review is not a standard-setting project, but it could lead to standard setting if the board was presented with evidence that there was a major issue that it had not contemplated when developing the standard. So Linda, can I turn things over to you to provide an update on this review?
Absolutely. So let me start with some background. I'll remind you that the IASB began the PIR of IFRS 15, revenue from contracts with the customers, in the second half of 2022. We then published a request for information in June of 2023 to obtain feedback from our stakeholders on how IFRS 15 is working in practice, and have been deliberating the feedback we received since February of 2024. We also discussed the feedback that we received with our various consultative groups and reviewed some academic research. We had a joint meeting with the FASB in June of this year to share findings from our respective PIRs of the revenue standards. So that's for us IFRS 15, and for the FASB it's ASC Topic 606, with the aim of keeping both standards largely converged. So at the July meeting, the IASB was asked to make final decisions in the PIR process. And most importantly, to the big picture headline, we looked at that and concluded that overall IFRS 15 is working as intended. We confirmed our previous decisions on application matters. Specifically, we decided to consider in the next agenda consultation the following application matters. Assessing control over services and intangible assets in determining whether an entity acts as a principal or an agent, accounting for consideration payable to a customer, applying IFRS 15 with IFRIC 12, and in particular in relation to accounting for contractual obligations to maintain or restore service concession infrastructure, applying IFRS 15 with IFRS 10 concerning accounting for corporate wrapper transactions, and applying IFRS 15 with IFRS 11 concerning accounting for collaborative arrangements. We decided to gather further evidence on the matters relating to assessing whether the transfer of an asset is a sale in a sale and leaseback transaction in the forthcoming PIR of IFRS 16 leases. Now, let me also mention something we decided not to do, as I think some stakeholders would be interested in this. We received in several different spots requests to move language out of the basis of conclusions and into the standard itself. So overall, when we discussed this, we weighed 2 considerations. We thought about the time and effort it would take stakeholders to potentially reevaluate previous conclusions reached because we actually changed the words in the standard itself, and the amount of time it would take for us to issue the ED for these changes, have our stakeholders respond, then we deliberate the comments received, and ultimately issue an updated standard. Because every time we change a standard, we must follow our due process. In the end, we decided not to make these changes, but emphasize the need for staff to continue to carefully evaluate what needs to be in the standard itself versus in the basis of conclusions. So with this, The IASB confirmed that sufficient work had been completed to conclude the PIR and for the staff to prepare the project summary and feedback statement. The staff will prepare the feedback statement and it will be reviewed by the board. The Due Process Oversight Committee will also be provided with a draft of the feedback statement. And once the Due Process Oversight Committee is satisfied that the IASB has completed the review satisfactorily, the feedback statement will be published. And we plan to publish the feedback statement in September of this year.
Well, thank you, Linda. A lot going on there. So let's move on to our second project that we will be discussing today, rate-regulated activities. As you might be aware, we're working on a new accounting standard that would require companies subject to rate regulation to give investors better information about their financial position and financial performance. To discuss this further, Tadeu, can I bring you in?
Well, of course you can, thank you. The new standard will provide information that will supplement information provided by IFRS 15 and replace IFRS 14 regulatory deferred accounts. This standard might affect companies that supply goods or services that are essential to customers, for example, electricity, water, or transportation. Many of these companies are subject to rate regulation that determines how much compensation that are entitled to charge customers and when they can include that compensation in the regulated rates. Differences in time arise when compensation for goods or services supplied in one period is included in the regulated charged in a different period. Our projects focus on this specific type of rate regulation that creates differences in timing. When such differences in time arise, the amount of revenue recognized in the period in accordance with IFRS 15, for example, may not include all the compensation that an entity is entitled for the goods or services supplied in that period, or it may include amounts that relate to compensation for goods or services but supplied in a different period. The new standard will provide information to users of financial statements about the effect of such differences in timing on a company's financial position and financial performance. And how do we achieve this? Well, by requiring companies to recognize regulatory assets and liabilities and regulatory income and expense. We published exposure draft regulatory assets and regulatory liabilities in early 2021, and the comment period was closed in July 2021. And since then, we have been redeliberating the feedback from the ED, and this month the project reached an important milestone because the IASB has finalized its redeliberations on the proposals in the exposure draft. At this July meeting, we discussed extending the measurement and presentation proposals in the exposure draft, dealing with items affecting regulated rates on a cash basis to items affecting regulated rates on other basis. This was a quite difficult discussion, and after a robust debate, the board decided by a narrow margin that the new standard will not extend the use of the measurement proposal, but will instead, for a narrow set of circumstances, include an exemption from discounting. On presentation, the board decided to extend this proposal. So what does it mean? It means that when the remeasurement of a liability on an asset is presented in OCI, and the regulators provide compensation for that liability or asset, companies will be required to present the related regulatory income or regulatory expense in OCI, independently on whether the compensation is on a cash or accrual basis. We also decided on transition. The standard will permit an entity already applying IFRS accounting standards to elect to apply the final standard fully retrospectively or by using a modified retrospective approach. Regardless of which approach the entity elects to use, the entity will be required to restate comparative information for the first year immediately preceding the year of initial application. Some transition reliefs will be available for entities applying the modified retrospective approach. Finally, we decided that the effective date for the final accounting standard will be for annual periods beginning on or after 1st January 2029, with early application permitted. And what are the next steps? The staff will now start the drafting and balloting process, and we expect that the final standard will be issued in the second half of 2025.
Thank you, Tadeu. And now let's move on to the final project for this podcast, which is the second comprehensive review of the IFRS for SMEs standard. So Linda, can you start by explaining what this standard is and why it's so important?
IFRS for SMEs is our accounting standard for entities without public accountability. So essentially, these are companies that do not list shares in a public market and do not hold assets in a fiduciary capacity for a broad group of customers like banks. This accounting standard simplifies full IFRS accounting standards while still requiring useful information to the users of those financial statements. And currently, we're undertaking a second comprehensive review of the standard. The IASB published an exposure draft in September of 2022. The comment period on that ended in March of 2023, and we have since been deliberating proposals in the exposure draft based on that feedback. At the July meeting, we continued discussions about whether and how to introduce an expected credit loss model for SMEs. The exposure draft proposed introducing the expected credit loss model for the impairment of some financial assets, but our stakeholders were just not supportive. The staff performed further field work on this question and presented its finding at the meeting. After considering the feedback from fieldwork and the importance of maintaining simplicity of the standard, we decided to withdraw the proposal in the exposure draft. So this means that the incurred loss model for the impairment of financial assets will be retained for all SMEs, but we will now require additional disclosure to show the aging of financial assets. We also discussed the requirements for issued financial guarantee contracts, and we decided to provide a simplification by including intragroup financial guarantee contracts in the scope of Section 21, Provisions and Contingencies. Other issued financial guarantee contracts would continue to be in the scope of Section 11, Financial Instruments, and will be measured at fair value through profit or loss. So our next steps, in September 2024, we plan to discuss feedback on the addendum to the exposure draft, for which the comment period ends this month. The final amendment based on this feedback will be included in the third edition of the standard. We expect that the third edition of the standard will be issued in the first quarter of 2025 with an effective date of January the 1st, 2027. So back to you, Nili.
Thanks, Linda. So that covers the three projects we had in mind for this podcast. As we wrap up this episode, I wanted to also highlight three consultations that we've published in July. So let's start with the first one, which is about translating financial information into hyperinflationary currencies. Tadeu, I know hyperinflationary currencies and the accounting for that is near and dear to your heart. So can you provide us a brief summary for our listeners?
Sure, I can, and especially because now we have more countries moving towards this profile. Then we are proposing narrow scope amendments to address accounting issues that affect companies that translate financial information from a non-hyperinflationary currency to a hyperinflationary currency. And we expect that proposed translation requirements to improve the information for users of financial statements while being simple and cost-effective for companies to apply. The consultation is open until 22nd November 2024, and we are inviting feedback from those that are interested or affected stakeholders.
Thanks, Tadeu. I'm going to put you on the spot again for our second consultation, which is proposing amendments to our newest standard, IFRS 19, subsidiaries without public accountability disclosures. So what are we doing with this exposure draft?
Well, first, just to remind our listeners, IFRS 19 simplifies financial reporting for eligible subsidiaries that apply IFRS accounting standards by permitting them to use reduced disclosure requirement. As IFRS accounting standards are developed and amended, IFRS 19 will be amended alongside them, always with a view to reducing disclosure requirement for eligible subsidiaries. And when we developed IFRS 19, we based the disclosure requirements on the IFRS accounting standards issued until February 2021. We have to have a cutoff date to make it feasible. At that time, we decided that for any new standards or amendments after this date, we simply would include the full disclosure requirements. This exposure draft is all about the planned catch-up with these new standards or amendments, with a view to reducing the disclosure requirements. Comment period for this consultation, it's open until 27 November 2024.
Great, thanks, Tadeu. And then last but not least, Linda, can I turn things over to you to talk about our exposure draft on climate-related and other uncertainties in the financial statements?
Happy to, because I think this is really a great thing that we're doing here, and we're anxious to hear back from stakeholders. So we're proposing 8 illustrative examples to illustrate how companies should apply the existing requirements in IFRS accounting standards when reporting the effects of climate-related and other uncertainties in their financial statements. Now, we developed these examples in response to strong demand from investors. They expressed concerns that information about climate-related uncertainties in financial statements was sometimes insufficient, or it certainly appeared to be inconsistent with information provided outside the financial statements. Our proposed examples respond to these concerns. They also aim to improve transparency of information in financial statements and strengthen the connections between financial statements and other parts of a company's reporting, such as sustainability disclosures. We're inviting stakeholder feedback until November 28th, 2024.
Thank you, Linda. For stakeholders who are interested in providing us feedback, please have a look at our website for these exposure drafts. We would be very interested in getting your input. And that concludes this episode. Thank you for joining us. You can find all of our podcasts on your preferred podcast app. For August, we will have a supplementary board meeting to discuss feedback on the exposure draft on contracts for renewable electricity contracts. However, we won't have a podcast for that since it's quite short. And our next podcast will resume in September, where we'll cover both August and September's board meetings. Until then, it is goodbye and thank you from us.